What's an ETF? Investing terms explained. Welcome to our video series designed to make investing simple and accessible for everyone, especially beginner investors. In today's episode, we'll focus on one essential term that every investor should know and understand: ETFs, or exchange-traded funds. By the time you finish this video, you'll have a clear grasp of what ETFs are, why they're important, and how they can be the perfect starting point for your investment journey. At its core, an ETF, exchange-traded fund, is exactly what its name implies. It is a fund that holds a collection of investments, such as stocks, bonds, or commodities, but it's traded on stock exchanges, just like individual stocks. Let's simplify this with an analogy. Imagine a fruit basket. Instead of buying individual fruits at a grocery store, you purchase an entire basket that already contains various kinds of fruits like apples, oranges, and bananas. Each piece of fruit represents a single stock, bond, or investment within the ETF. By buying the basket, you own a small share of all these different investments bundled into one. That's essentially what an ETF does. Investing can often seem intimidating, especially with so many terms, options, and risks to navigate. ETFs reduce that overwhelm by offering simplicity and accessibility. They are an excellent way for beginner investors to start building wealth without needing extensive knowledge of the stock market or deep financial expertise. ETFs are particularly valuable because they allow you to invest in multiple companies, industries, or asset classes at once. This diversification helps reduce the risk of putting all your money in a single stock, which could fluctuate significantly. ETFs operate like a big investment package. Fund managers create these funds by combining a mix of financial assets like stocks or bonds. Once the fund is set up, it is listed on a stock exchange for regular investors to buy and sell. For example, let's say you're interested in the technology sector, but feel unsure about which individual tech company to invest in. An ETF focused on the tech industry may include shares of multiple companies like Apple, Microsoft, and Google. Instead of buying shares in each of those companies individually, you can buy one ETF and indirectly own a piece of all those businesses. To understand the convenience of ETFs, it's helpful to compare them to individual stocks. When you buy a stock, you're investing in a single company. Your returns depend entirely on that one company's performance. If the business does well, your investment grows. If it performs poorly, you could lose money. With ETFs, the story is different. Since ETFs include multiple investments across various industries or asset types, the risk is spread out. This diversification makes ETFs less volatile and safer than holding individual stocks. One of the great features of ETFs is how they're traded. Unlike mutual funds, which are typically bought or sold at the end of the trading day, ETFs are traded on stock exchanges throughout the day. This means you can buy or sell an ETF at any time during stock market hours, just like you would with a company's stock. This flexibility makes ETFs a particularly attractive option for people who value convenient and accessible investment opportunities. You've probably heard the term diversification before, but what does it mean in the context of investing? Diversification is a strategy where you spread your investment across different assets to reduce risk. The logic is simple. If one of your investments doesn't perform well, others might, balancing things out. ETFs are natural tools for diversification. For instance, if an ETF focuses on the healthcare industry, it might include investments in pharmaceutical companies, medical device manufacturers, and health insurers. This variety ensures that your investment doesn't depend solely on the success or failure of a single company or sector. Another advantage of ETFs is their cost-effectiveness. ETFs typically have lower fees compared to mutual funds. This is because most ETFs are passively managed, meaning they simply track an index rather than trying to outperform the market. As a result, the management fees, also known as expense ratios, are much lower, making them ideal for beginner investors who want to keep costs down. ETFs are incredibly flexible, catering to a wide range of financial goals and preferences. Whether you want to invest in a single industry, track the performance of the entire stock market, or even target something as specific as sustainable energy companies, you can find an ETF that matches your interests. This flexibility allows you to build a customized portfolio that aligns perfectly with your short-term and long-term financial objectives. One of the greatest benefits of ETFs is their accessibility. You don't need a huge amount of money to start investing in ETFs. Many platforms allow you to purchase fractional shares, meaning you can begin with as little as $5 or $10. This low entry point makes ETFs an excellent way for beginners to test the waters of investing without feeling financially overcommitted. To provide some context, here are a few examples of popular ETFs. S&P 500 ETFs. These track the performance of the 500 largest publicly traded companies in the United States. Technology ETFs include companies like Apple, Microsoft, and Tesla. Dividend ETFs focus on companies that pay regular dividends to investors. The wide variety of ETF themes ensures there's something for every investor. ETFs make it easy to target specific industries or sectors. For example, if you're optimistic about the future of renewable energy, you could invest in an ETF that focuses on solar power, wind energy, or electric vehicles. Sector-specific ETFs allow you to align your investments with industries you believe in or are knowledgeable about. Investing in global markets has become increasingly popular, and ETFs offer an excellent way to gain international exposure. Global and international ETFs allow you to invest in companies from countries around the world, further diversifying your portfolio and mitigating geographic risks. Many beginner investors wonder how ETFs differ from mutual funds. While both are pooled investment vehicles, ETFs have some unique advantages. ETFs are traded throughout the day, while mutual funds are only traded at the end of the day. ETFs generally have lower expense ratios than mutual funds. ETFs don't have minimum investment requirements, unlike many mutual funds. These features make ETFs more appealing for those just starting their investing journey. Many investors struggle to track multiple individual investments, especially as their portfolios grow. ETFs solve this problem by grouping multiple investments into a single fund, simplifying portfolio management. With just a few ETFs, you can effectively cover multiple sectors, asset classes, or geographical regions. ETFs can be classified into two types, active and passive. Passive ETFs are designed to track the performance of a specific index, like the S&P 500. Active ETFs, on the other hand, are managed by professionals who aim to outperform the market. For beginner investors, passive ETFs are often recommended due to their lower costs and long-term stability. While ETFs are generally safer than investing in individual stocks, they're not without risks. Market volatility can affect the value of an ETF, particularly those focused on a specific sector or region. To mitigate these risks, research the ETF's focus, understand the market conditions, and ensure your portfolio is diversified across multiple ETFs. Choosing the right ETF may feel daunting, but it doesn't have to be. Look for ETFs that align with your financial goals, whether it's saving for retirement, building an emergency fund, or growing long-term wealth. Research the ETF's holdings, expense ratios, and historical performance to make an informed decision. ETFs are an ideal starting point for beginners due to their simplicity, affordability, and ability to diversify risk. They allow you to participate in the growth of multiple companies or sectors with a single purchase, offering a balanced approach to investing. Beginning your ETF investment journey is easier than ever. Follow these steps. Open an account on a reputable brokerage platform. Research ETFs that align with your financial goals. Determine how much you want to invest. Purchase your chosen ETF and monitor its performance over time. Here are some common pitfalls to steer clear of. Overtrading. ETFs are designed for long-term growth, so avoid frequent buying and selling. What's an ETF? Investing terms explained. Ignoring fees. While ETFs are low cost, small fees can add up over time. Always review the expense ratio. Lack of research. Make sure you understand the ETF's focus and holdings before investing. Now that you understand the world of ETFs, you're one step closer to becoming a confident investor. Take the time to research ETFs that match your goals, consult a financial advisor if necessary, and take that important first step toward growing your wealth. ETFs are a powerful tool in the world of investing, especially for beginners. They offer diversification, flexibility, and affordability, making them an easy-to-understand and effective starting point. By investing in ETFs, you can create a balanced portfolio that aligns perfectly with your goals, all without the stress of managing individual stocks. Investing doesn't have to be complicated, and ETFs are the proof. Now it's your turn to explore the possibilities and take control of your financial future.